Dr. Dahlstedt is one of our co-directors for the AgriBility project, and he brings in an extension perspective, agriculturally based extension perspective. And today he's going to be doing it regarding tax issues for this last year. Is there something?
The clicker.
Got it.
Oh, clicker. You have a clicker. Okay. And I'm just going to move this like this for you, sir, so you don't have to walk around with it. You want to sit down?
No,
Okay. Want a podium?
I'm getting pretty old.
Okay. Raise your hand and I'll scoot up a chair.
Oh, okay.
All right, Dr. Dahlstedt?
All right, thank you. All right. I'm going to share with you some tax considerations that are possibly facing production agriculture. Some of them are already in place, some are not. So we'll try and delineate those as we go through this. For the 2020 tax planning year, these are some things that people have not paid attention to. Is we do have any payments, and you should have gotten a notice from IRS or from the federal government whether that income is taxable or not. Is that gonna?
You about 4 down, looks like the soap that's off right there. So.
Oh, okay, found it there. And if you get natural disaster payments like we've had occur in agriculture a number of years here in Colorado as well. If you had any grants or outright loans that fall underneath the CARES Act, they also could be income. Okay, I think there's a couple others. You typically are going to get a 1099-G government form, or if you have disaster payments, you could get a CC 1099. Depends. Regular crop insurance proceeds obviously are on a 1099 miscellaneous. So one thing I caution people is that don't ignore 1099s. That's the way IRS tracks income. So sometimes people will forget to include 1099 income and they'll get caught for it. The other thing is, if you're have hired labor, make sure you're making those contributions to the federal government. I've been involved in numerous Chapter 12 bankruptcies in this state, and in Kansas, and Nebraska, and Wyoming. I've even done a couple in Utah, where one of the first things people do when they're short of money, they may pay their labor, but they don't pay in the withholding. That's 7.35%. So make sure if you're in that situation that you do account for that. Okay, the state and federal laws could exclude some COVID-19 related payments. The Paycheck Protection Program, PPP, that could be excluded depending on the amount you got. Also, the economic injury disaster loans advances could be excluded. So you need to check. That's why I think it is this current year, 21, if you haven't filed your taxes, I certainly would talk to a tax accountant that knows their stuff. And if you need the names of some, there's a number of them here in Sterling. The one I work with that did our custom harvesting business is located in Greeley. And most of the time, those people go to tax seminars. So they know what the current laws are and what are the changes. And so you need to pay attention to that. This is one that has gotten more farmers and ranchers in trouble than any other thing. Section 179, what is that? It's capital expensing. So typically, and this year, 21 is a good example. We had good prices on corn and wheat. So all of a sudden we have a big taxable income. So what do? We go out and buy more machinery, assuming you can find something to buy. But basically, and then we write that off because Section 179, we can write off up to $1,050,000 in any given year. And the limitation is 2.6 million. That's when you get a dollar for dollar reduction in your Section 179. can't say I haven't used that in the harvest business, but typically what I've seen in the chapter 12s is that, in fact, what we had, maybe 5-6 years ago, we had a terrific sugar beet crop and terrific prices. And what happened? A couple farmers I worked with went out and bought a whole bunch of new green paint. Wrote it off on section 179. The problem is that they didn't have enough cash to cash out the tractor or the combine or whatever they were buying. So the next year they had payments on it. And then we had a downturn. That's when Great Western went south in Fort Morgan, and we had some real problems. So you got to be careful and make sure you have good rationale for why you're going to exercise that section 179. I just go by an old rancher out of Kremling told me back in the 80s, and I think we should live by that, is that he said, you know, I've never seen anyone go bankrupt for paying taxes on profits. And I think there's a lot of truth to that. But if you're a farmer or rancher, one of the worst things you can do is what? Pay taxes. Terrible thing. Terrible
Yeah.
thing. But, and here's another little side note to that. That also diminishes your Social Security contribution, your self-employment tax. So what happens? Me and my dad had a pretty good sized farm in North Dakota. And when he passed away, my mother was eligible to start drawing Social Security. Thank God she had the farm, because her Social Security was $400 a month. My dad did not believe in paying taxes. So anything he bought, like when I was in Vietnam, he bought a section of land. He would have bought 2 sections, but he didn't have enough cash. He only had cash to buy 1. So make sure you're doing a self-employment. And very often you can employ your wife, make payments for her, pay her a wage, and do the withdrawals and so on. So she'll be eligible for a better Social Security. Now, the question is that Social Security is going to be gone by 2035. Anybody believe that? I mean, if we're willing to spend $6 trillion in the last 18 months on COVID, seems to me like wrestling up another $1 trillion or $2 trillion to bankroll Social Security is not going to be a problem for our Congress. But anyway, the problem is going to be who in the hell is going to pay for it? We got that problem right now, big time. And it isn't Putin's fault. Okay, some of the qualifying property, purchase livestock, not raised, purchase livestock, obviously machinery, single purpose ag structures, new or used assets qualify, so you can buy a used tractor, used combine, whatever. You can't buy the asset from a lineal descendant. So it has to be like an arm's length transaction. And it must be available and ready for use is the other criteria. All right. Capital gains, another growing issue in our country. We have short-term capital gains, which is basically you've held an asset for approximately a year. That gain rate is going to be similar to what your marginal income tax rate is. However, if you have long-term capital gains where you've held an asset longer than a year, there's different. There's different rates. If your income is, I think, is below 40,000, you probably are not going to have to pay any capital gains at all. And then from 40 to, I can't remember, 85 roughly, it's 15%. And then if it's greater than that, it could be up to 28%. And obviously the rules are different for home sales. So you as a homeowner, married, you can deduct a $500,000 capital gain. You don't have to pay capital gains on a $500,000. Biden is trying to increase this to 28 or 29%. That's going to create a major, major problem, ladies and gentlemen. Because in agriculture, what is one of the biggest barriers we have when we try to pass on our farm or ranch to our kids?
Okay.
Capital gains. Anyway, I'm going to say more on that. Income tax brackets, here's another one that Biden's trying to increase. But this morning I heard on the news is that he's going after 700 billionaires in this country. So if you earn more than $100 billion, your tax rate's gonna be 20%. And my question is, I think those people are already paying basically 80% of the tax revenue in this country the way it is. So now you're gonna add on more tax burdens? They're the people that create jobs. New investment. Dumb economics is what I call it. All right, but they're talking about increasing it from 37% to 39%. What was the tax rate when Reagan was in charge? He got it changed. What was it during JFK's? One of our more famous loved presidents. 90% over a certain amount was taxed at 90%. Reagan got it reduced down, but it's always been fairly high. This rate here, of course, 10, 12, and I'll look at some numbers here. If you have income from 0 to 9,900, basically it's 10%, 12%. When you go from 9,951 to 40,000, goes to 12%. And you can see how it's calculated, okay? And of course, most people in this country probably are going to fall in that 12% range, maybe 14. Why? Because of the standard deduction. I think this year is up to what, 12.7? I file income tax on a single basis. My wife files her own. Did you file yours yet? Is it up to 12.7?
Wife takes care of that.
Oh, you should know that, Chad. You need to keep track of what's going on income tax wise. I think it's 12.7. Okay, good. Economic impact payments as part of the American Rescue Plan. Payments made to a single filer earning less than 75,000 and families under 150,000. You may have tax. I got a letter from IRS because I got one payment. So I had to report that as income. Okay. So most people got at least one payment. I actually got the very first one was like $23.82. And I'm going, what the heck is this for? So I went and bought a case of Coors Light and didn't worry about it anymore. Bigger child credit, 2,000 to 3,000 for older children, 3,600 for younger children. They're trying to reinstate that, but this is what was ongoing over the last couple of years. Obviously, that benefits a lot of people. I have never had a child in childcare, but my youngest son has a couple in childcare, and it was more economical for one of them, either him or his wife, to quit working. Because her whole salary was going just to cover childcare. So there were money he had to basically want them to stay home. So this has benefited a lot of families, which is a good thing. Okay, I don't have a problem with this stuff. I have problems with other stuff. I like those PPP loans. I mean, I'll give you a perfect example. One of my good friends out of South Dakota is a pretty good sized custom harvester. He had 5 guys hired to go south a year ago. And as a week before he was going to leave, none of them had showed up yet. So he said, I started calling them. And he said, the first 2 guys I talked to said, we're not going. We're getting X dollars per month. We're just going to stay home and have fun with our girlfriends and drink beer. We don't need to work. And that's the problem that this direct payment has caused. That's why we have all these high unemployment numbers. Even just walk downtown, they don't have people to work. There's signs hiring all over. Wages have gone up. Still, they can't find anybody to work. So it's created a real problem. Another one that farmers, one thing I would preempt this by saying farmers and ranchers have a lot of tax benefits, attributes, let's call it that, primarily because they report everything on a cash basis, okay? Unless you're incorporated, if you're a subchapter S or a C Corp, you have to file on an accrual basis. But if you're a sole proprietorship or a partnership, you can file on a cash basis. So what happens is they don't have to worry about it this year because fertilizer tripled in cost, so they don't have to worry about prepaying half of their expenses because they're going to more than triple their expenses. So in the past, though, we could deduct up to 50% of our previous year's deduction for various inputs, fuel, fertilizer, chemicals, whatever, but you have to have taken delivery on it. It's not like you make a down payment, okay? It's you've had to take delivery, okay? So it has to have a business purpose. It's not strictly just for tax reduction. Okay. This is the one I'm really concerned about. Is inheritance tax or estate tax or whatever you want to refer to it as. Currently, it's at 11.7 million. Every one of you in this room has a one-time tax exclusion of 11.7 million. So for the two of you, that's 23.4. So if you have less than 23.4 million in assets, you don't have to pay any estate tax. And the maximum rate is 40% for anything over the 11.7 or 23.4. The other thing, which is really nice, is portability. So let's say we don't use, who dies first, by the way? Let's get that cleared up. Who dies first? Man, you guys gotta take better care of yourselves. Okay. If there's any left over, so if dad dies and they use 5 million, while the remaining 6.7, it's carried over to the wife's estate. And you go, well, hell, she's never going to use all of that. Oh, tell me about it. My dad died when he was 58. My mother lived for another 25 years. That land that we own in North Dakota went from $650 an acre when my dad died to $6,500 an acre today. In fact, I think it's closer to 8,000 today. So she would have needed all of that. Luckily, she got it passed on to us, her kids, before that happened. So the future law, when this thing expires, see, 31 December 25, it's going to revert back to 5.5, basically. Biden has been supporting 3.5. That's back when we were in 2009. That was a max that George W. and Obama didn't change. He reinstated the 3.5, but that's where they want to go back to. Is that going to affect a lot of farms and ranches in the state of Colorado? You're dang tootin', a bunch of them. I would argue that maybe as many as 70% of the farms and ranches in this state will be impacted by that. And what happens? If that becomes law, what happens to those farms? They go away because they got to sell the land to pay the tax. So we saw a lot of that in the 90s before they changed the laws. Lifetime gifting, right now, every one of you in this room could gift 11.7 million, one-time gift, or you can gift a portion of it annually. Future law 3.5 will be the max, and they're talking about in the future maybe 1 billion. Annual gifting, you can gift as much as you want. The thing is, you don't have to report it to IRS if it's 15,000 or less. If you gift more than 15,000, you have to file a separate tax return, and I think it's something like a 2078 or some number. Anyway, so, and if you're married and you gift say 18,000 to a son. Dad does, mom has to sign off on that and say it's okay, or if she gifts it, dad has to sign off on it. So once it's over 15,000, it's handled a little bit differently, okay? Basis, this is why a lot of farm families, ranch families, wait to pass the land on at the time of death, because you get a stepped up basis. If you gift it to the child or whoever, a nephew or whatever, or Norm Dahl said, I don't care, whoever you want to gift it to, I get your basis. So if you paid $200 an acre for that range ground, that's the basis I get. So that's the step up. Now there is, and this is blocked out here. What I'm concerned about is in the initial estate laws that came out, they were talking about a carryover basis. So when I inherited my dad and mother's land, I would have gotten her basis, 650, not the stepped up. So that makes a big difference. So that's what we're talking about, carryover. That could appear again. Okay, so what happens here? Sunsets, exemption, look, there's no tax under the current law. Under the 25 sunset, the tax all of a sudden becomes almost 5.5 million. And on the other proposition, it's 3.5. So the taxable estate goes up, and of course the estate tax goes up. So that is a concern, particularly from my standpoint, because all I've done my entire career is work with farmers and ranchers. When I've taught at CSU, mostly we're ag kids going back to the farm and ranch. In many cases, I tried to impart on them this type of knowledge so they knew what they were going to be faced with and why it was so important to get their parents or grandparents on the same page as they were. Okay. Any questions for me? This is kind of a brief 30-minute roundup.
I have a question for you.
Okay, the answer is 32.
Well, if it has anything to do with math, I'm glad you gave it. So we run into a lot of couples where everything is in a father or grandfather's name, and the wife or mother or all of the above or daughter are working hard on that place, and then they become sick or injured. Okay. What would you advise us to help them, because they have no recourse, they have no unemployment, they have no record of working there.
Right.
It's really tough to try to find resources when they don't really have kind of that paper trail of employment on the family farm.
Yeah, that's sort of a multifaceted question there. One of the big problems that I've run into, and my colleague Jeff Bell has run into, is people die and then they go to transfer the title on the land. And actually one case that I was involved in, the land was in great aunt Matilda's name back 1917.
Oh, wow.
So they had not updated the title on, I don't understand why, but they never updated the title to the current ownership. Okay. In terms of salaries, is that what you're kind of getting
Well,
at? So
I
they
guess
can
it's-
qualify for Social Security or?
That and like when we work with the Division of Vocational Rehabilitation, a lot of times they have to kind of have an employment kind of record and an earnings kind of situation. And they don't, and they don't have any ownership necessarily on paper, but they've worked, they've worked 20 years, 100 years, whatever they've worked.
But they filed tax returns.
Well, the farm did.
Well, yeah, but most of the time I would guess they should have a K1 in if it's a partnership or a
That's a
an
thing that's in
LLC
there.
or whatever, they should have a K1 to do it legally.
Enlisting that,
Yeah,
okay.
and so that would give them their share of the profits on that partnership or whatever LLC or LLP had for the previous year. So people typically have some data,
So someone's listed them,
yeah, something that
capacity
should
of
be
working.
something, yeah.
okay.
The other thing is, they should have, if they were like a custom operator,
Mhm.
they should have gotten 1099s from the people that they did work with. So that would be a source of income or where they've received income. But that's why I mentioned that earlier, that for farm couples and ranch couples, I know a number of ranchers and farmers that have their wife on the employment rolls
Mhm. That's
and
what I'm
pay them
talking
and
about.
pay them a salary each month or a year or whatever, or make a contribution to a Roth IRA or whatever. Okay, that demonstrates that this person has earned income off this operation. So,
That's kind of what I'm
Yeah.
speaking to. And it was a particular client that was actually, was in South Dakota, that was going back there, and she was really struggling. It was her husband's family's ranch farm that she'd been working on for a good 10, 12 years, now became disabled, and there was difficulty where she fit in with any kind of accountability as someone who did a lot of work but wasn't really on the records.
did the husband own property?
Dad owned everything,
Dad owned everything. Did he get an affidavit from dad?
possibly, but that's kind of where the scenario came up, and we were really struggling with how do we look at her accountability and address some of her limitations.
I'd go after dad. Have him prepare something that would
Give testimony.
give her give her information that would benefit her from that standpoint.
Interesting.
But that there's all kinds of issues that go on out there. Most farmers and ranchers are not good accountants. Their wives might be, but they themselves and often overlook documenting it. Particularly like on land. What did you pay per acre for? Where's the documents that tell, what was paid? Where's the title at? I use my example of my dad. He was a pretty dang good financial manager, but he didn't always notify everybody in the family of what the heck was going on. Now, if we were going to buy bulls, we had a family conference on what we're looking for bulls. Or if we're going to buy a new combine or a new tractor, we had some input there. But I never did see a balance sheet that he prepared. I never knew what he had for insurance until my mother decided to sell this pickup because it just sat in the garage for 4 years and she's cleaning out the cubbyhole. Well, there's a paid up $20,000 life insurance policy.
Wow.
We didn't know about it. So, you got to really, one of the things that I do when I work with couples is I have a checklist, 29 different things you need to do. Tell people where the key to your safety deposit box is. Where are all your titles? Where are your insurance papers? Simple things like, you're a military veteran. Do you want a military funeral? Do you want an honor guard? That type of thing, So there's lots of things people can do. Well, then you get nervous because what's the worst thing we can do is talk about death and dying, isn't it? How many of you have done your own obituary? James and I. Yeah. I want to write about me. I don't want somebody else writing about me because I don't know what they're going to say. Not that it's going to matter to me, but write your own obituary. What do you want to have in your service? Do you want to have certain songs, or do you want to have honorary pallbearers or a memorial service? You want to spread your ashes over your enemies' territory or what? Do simple things like that. You'll save people a lot of headaches, for for sure. Anyway, I got off on a,
Well, I
I'm like
appreciate
Judge Edel, I got off on a little sidebar here.
I think that's valuable information for us.
Okay,
Is-
good.
Is a lot of people here today are kind of on the business end of the agricultural things and things that you could advise or encourage people to do, as well as the farmers and ranchers that are here is pretty helpful. Thank you for getting
Well,
on
you
this
know,
topic a little bit.
You know, really, as a farmer or rancher, that's your responsibility. That's part of your management scheme. Is this stuff,
The taxes and
the
everything. like that.
taxes, yeah. I mean, yeah, you can have an accountant do it, but you need to get a copy of the Farm Publication 225. Because there's changes in there. IRS lists them. You know, Jeff, my partner down in Pueblo, he goes to Washington DC every May trying to enhance that publication. So it is more oriented towards the layman. But read that. So when you're making purchases or selling stuff, you know what the tax implications are. Let me give you a simple example. You buy a tractor or whatever, it doesn't matter. You buy this implement, the 1st of July of this year. And then next June, you go, I really don't need that. So I sell it. But you depreciated it for last year, didn't you? So now you got to go back and file an amended tax return and recapture that depreciation because you're not allowed to have it because you didn't keep it for the full year. You only kept it for 11 months. It's just simple things like that can get people in trouble. So particularly if it's big items. We're saying it was a $200,000 tractor and I expensed the whole damn thing. Then you're gonna have to go back. Face the music, so to speak. All right, that's enough.
Any more questions for Dr. Dahlstead?
You didn't give us your phone number. Is there a reason
Well,
for
I'll
that?
All right, what I'd like to do, thank you, Norm, for sharing that information. By the time we get done with all these workshops this week, maybe I'll understand some of it. Because sometimes I don't get it. So what I'd like to take a few minutes is, Jim pointed out to me, I didn't make introductions. So I'd like to have you all introduce yourselves. My apologies for that. If you could just say who you are, if you're with an organization or a provider or your client or whatever, if you would please do that. I'm going to start with Chad and we'll kind of just go around the room, please.
You want me to stop recording this? Because we're breaking up into 3 sections, so Norm's piece is done. So should we just stop that?
Yeah.
Not record everyone? Okay.
We'll do that. Thanks. And as you introduce yourself, we do have coffee up here.